I really did two separate presentations because 2 or 3 weeks ago, when I put this presentation together, I feel like the world was very different then. And it's only been 2 or 3 weeks. So I think the timing for this one is really, really important because just in the last 2 weeks, there have been big news, big shakeups, geopolitical shakeups that affects our economy substantially, affects interest rates. And this is a great time for us to all come together with all of this new information, and hopefully from my perspective and JWB's lens, we can start to, I think, calm the noise in some places.
I think that when you validate for the community kind of like what we're all thinking or what we're all hearing, there's a certain sense of like calmness, right? Like there's a certain sense of like acceptance of, okay, this is really what's happening. I'm not crazy. Because at the end of the day, the not your average investor community is exactly that.
What do we see as owners of, hundreds of single family rental properties and with, over $1 billion of management? What do we see so that we can better inform you and ultimately give you more confidence? And what is a chaotic time to be living and investing? The major theme and the major takeaway here is that this concept of normalization for pricing and rents continues to play out in Jacksonville and across the U.S. So the median home sales price here in Jacksonville is $350,000. That has led us to home price appreciation of roughly flat, right? About 0.6 negative over the last 12 months. Our average turnkey home price is about $243,000. Median days on market's 52. Months of inventory is 4.1, which we've talked a lot about how months of inventory is a leading indicator of home price appreciation. And so 4.1 is right where we expected it to be. And then foreclosures are almost non-existent, under 2%. And a normal market has 10% of the homes that are selling in foreclosure. So very normal market when I look at what prices are doing here. This concept of normalization is that over time, there are cycles to real estate. And if you believe that real estate is cyclical, which is what the data has proven, you're going to always kind of come back to that normal trend line for growth in your marketplace. Our actual median home sales price was slightly above the line, a year ago or whatnot. And then it is now slightly below the line. If you believe that home prices are cyclical and you're below the trend line, you think it's going to get back to the trend line, then yeah, you would believe that there's going to be an increase in home price appreciation at some point over the next market cycle to get you back up to that trend line. And we would believe that.
Makes a lot of sense.
Man, things changed very quickly. As I start to now just look at the investor lens, oil prices are rising. The Strait of Hormuz is largely closed right now, which is sending global shockwaves as far as the cost of energy. When that happens, the cost of gas, transportation, goods all rise. When gas or energy costs go up substantially, it's like a tax on everything in the economy. What's happening is energy costs are going up, inflation is going up. And then what does the Fed do to combat this? They keep their Fed funds rates elevated. By doing that, it increased the cost of borrowing for everybody in the country because people are concerned about inflation and don't know how long this war and conflict may last. People are fearing this inflation effect, and ultimately mortgage rates have really jumped in the last couple of weeks. What this means for housing is that when you have higher elevated mortgage rates, housing demand is suppressed. It doesn't eliminate the demand. It just keeps buyers on the sideline longer. But not only is demand suppressed, but supply is also slowing. Because we have already been in a situation where we're undersupplied on the single family housing side. But now when rates stay elevated, that's an increased borrowing cost for a builder. They're not going to be in a rush to go and overbuild and correct the supply problem. So when you have some demand that is suppressed, this is one of the best things about investing in single family rental properties, in my opinion. It's because your risks are mitigated. I always want to be in a position of strength as a rental property investor. And again, that's one of the reasons that I love this asset class. It's because it performs really well in times of chaos. In times of high inflation, owning a hard asset and buying it with debt is one of the best things you can do because you win when you own a hard asset and inflation happens. You do that in two ways. Number one, when it's a hard asset like a rental property, the growth of the asset is largely linked to inflation. If you look over long periods of time, you'll see that the average growth rate for single family homes is largely tied with the average inflation rate over the economy. So you win when inflation happens because your growth is largely tied to inflation. It's not the same with other asset classes. But the other hidden part of this, and what I hope to get a little bit louder with, I think it's a little bit more of a complex topic, is just talking about how you win when you borrow in times of high inflation. When you buy a hard asset and you borrow and you buy that asset with debt, what you're doing is you're taking out fixed rate debt and you might be paying that back over 30 years. Well, as inflation is higher, you win because you're paying that debt back in less valuable dollars. So the real benefit of how you are in a position of strength is, number one, your risks are mitigated from a rent and a pricing perspective simply because of supply and demand. Over time, your assets should grow with inflation. And then you can really win when you borrow, especially in times of high inflation. And that's what successful rental property investors do.
Next context change, the 21st Century Road to Housing Act got it's announced. I honestly don't know that much about this, GC. So what's the situation with the 21st Century Road to Housing Act?
You know, this institutional ban of buying single family homes, and a lot of noise. President Trump gave an executive order and said that he wanted to ban institutions. So then we started to go into the data, and I brought it to everybody here on the show and added some perspective and just shared with you all that, you know, this wasn't something that was really going to materially affect affordability, just simply because institutions don't own a lot of properties. It has been overblown as far as institutions potentially coming in and buying up all the homes in the neighborhoods and all this. It's just hasn't materialized. But what I wanted to talk about today is one of these rules inside this restriction of institutional investors is very concerning to me. There are only 314 investor groups in the entire country that have 350 or more homes. That's 0.7% of all the U.S. single family homes in the entire country. So you're going to restrict activity for those guys, which is okay. That's totally fine. Big picture, it's not going to do a whole lot. But the way that they're restricting that can have very adverse effects. It all comes down to this 7-year rule, which is this big issue for institutional investors. What the regulation says is that institutional investors must sell their single family homes within 7 years and only to individual homeowners. Institutions are the ones that are doing build to rent. That if they can't do it because it doesn't make sense to do it, then you're going to ultimately restrict supply that could help with affordability. Last year, JWB built, I believe, 331 homes. If you fast forwarded years in the future after this legislation was passed, JWB would not be allowed to build those 331 homes and add that supply. We wouldn't be able to sell it to you as an investor. So you can just wipe up those 331 homes of supply. Plus, you know, we're a very small, quote unquote, institution, right? And others can have a much more dramatic effect on build to rent than JWB can. So let's hope that doesn't happen.
Let's hope it doesn't happen. All right, GC. So then that is context change number 2, takeaway number 2. Context change number 3, I feel like this is something that happens every first, you know, like every
This is my favorite part.
This one we've lived before. And it's this idea that during the first quarter of the year, you're going to see real estate headlines that are super doom and gloom. Tell me more about this one, GC.
Happens every year like clockwork, right? And these were especially doomy and gloomy from some of the most respected names that we know in the media. Wall Street Journal, Reuters, all talking about home sales dropping to more than a 2-year low. And largely these headlines came out around January. The problem here is that these headlines have one consistent problem. They only talk about month-over-month data. That's why my friend who asked a really good question earlier, I said he or she really knows something, because you must look larger and farther and have more perspective. You need to look year over year. Well, these headlines reflect month-over-month data. So I said, okay, well, let's look into the month-over-month data. So here's Jacksonville's month-over-month data from December of 2025 to January of 2026. Let's see if this feels like a noteworthy article to write. Home sales dropped 36% in 1 month. Oh my gosh. Inventory went up 6%. Look at months of inventory. It went from 3.6 to 6 months of inventory. That's a 67% increase. Oh my gosh, right? And then of course, median home sales prices went down 4%. You could see how somebody who doesn't have perspective and understand that you shouldn't analyze real estate month over month, and you definitely shouldn't analyze it December to January. Why should you not? If you're going to missed the analysis here. Why would December to January be the worst time to do
Because
that?
nobody moves during Christmas. Nobody wants to sell their home during Christmas or buy a home or like go through that.
Exactly.
Yeah.
Exactly. So on the decision-making side, people don't want to be thinking about buying a home as much as they do at other times in the year. So the decision-making slows down. Here's the other side of it, though. You speed up the closings because your CPA tells you should close before the end of the year. All of the mortgage professionals want to get their numbers in before the end of the year to hit their bonus.
Yeah.
Agents, right? Title companies, everybody is pushing. They push at the end of every quarter, but they definitely push at the end of the year. So like clockwork, every December you have a ton of sales. And then what happens in January?
Everybody chills.
Everybody chills.
Takes a deep breath.
Well, people start to make decisions in January, but it takes 60 days for that to work through the timeline. So in January is when sales slow because nobody was making decisions 30 to 45 days earlier. So you don't have those closings. And then you also are coming from a really high number in December, which makes January look worse. Let's actually look at this the right way. Let's look year over year and let's see if it tells a different story. And what do you know? It does. So if you look year over year, January 2025 to January 2026, you see a much different story. Home sales actually increased 2%. Inventory actually went down 8%. Months of inventory actually went down 10%. And then home prices actually went slightly up. This is the effect of what we call seasonality. It is here in real estate for sure. It is, and I always like to talk about concepts, but also show graphically what I mean. Seasonality to me means like the EKG effect, right? So you've got like this up, if you're looking at the blue lines, it goes way up, and then it goes down, right? And then if you go back, a year before that time span, it went up and it went down. And then you go a year before, it's the same kind of time limit, and then went up and then down. And it's every single year with the exception of, 2020 to 2023, because the world was crazy at that point, and there was no months of inventory at that time. So we'll just put that as an outlier, right? But before that, right, it's the EKG effect. That's seasonality. That's why every December to January, you could write an article about home sales going down. And that home prices probably went down, and that inventory probably went up, and months of inventory spiked. People are just misguided when they're talking about home sales crashing, specifically month-over-month data. It's just a sign for you. If it's month-over-month, don't pay any attention to it. Go year-over-year.
Your 3 investor takeaways for this quarter with these context changes: the war in Iran may cause housing challenges in the short run with higher interest rates and uncertainty suppressing demand, but low supply today, constrained supply going forward, and inflation will lead to increased growth in the long run, proving out that single-family rental properties are the ultimate kind of like resilient asset class.
Well said.
Second takeaway, new housing affordability bill will have little impact on institutional ownership today, but the legislation risks reducing housing supply, disrupting capital, and hurting affordability instead of helping it.
Couldn't have said it better myself.
And then the last one is continuing to normalize. And that's all we need as investors. Buy and hold investors who invest with the right operator are in a position of strength. Sounds like stay the course, JC.
Yeah. And this last little point here, that's all we need for investors. I wanted to make sure people hear that, right? All we need for this asset class is normalization. Normalization gets you to those financial outcomes. Normalization hits every one of those pro formas that we have. All we need is normalization. I think for all of us, people have been conditioned over the last 5 years for it to be the greatest thing in the world because interest rates were so low, or they've been conditioned that it's somehow going to fall off a cliff. And that's just not how it goes. It just performs normally, even when the world tends to be on fire. So all we need is normalization. That's what we're seeing, and that is what we expect to see.